Hello guys, welcome back to another video. Today we are going to be talking about introduction to structure, and we're going to talk about the idea of institutional order flow and how we use institutional order flow to try to always be in the right side of the market. And we're going to touch just a little bit on market fractality, but we're going to go into fractals on the next video. Okay, today it's just going to be a quick introduction, and then the next video is going to be really in depth. But we're going to make this video also, like, we're going to drop a lot of diamonds in this video as well. Okay, so let's start. Okay, so market structure. What is market structure? Well, market structure is the way the market is delivered to us, right? And usually market can only moves in two ways, right? I mean, three ways, right? Market can either move up, right, an uptrend, or market can move in a downtrend, right? Or the market can also move sideways, and that's called consolidation, right? So those are the three ways that the market is gonna move, and that's what price is gonna be delivered to us all the time. Okay, so the majority of people that are already involved in the trading, they already kind of know what market structure is, right? I think the majority of people know that, you know, if I tell you what's an uptrend, they know it's a series of higher highs and higher lows, and downtrend, it's a series of, you know, lower highs and lower lows, right? But you know, what's the structure of an uptrend, right? An uptrend is a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and so on, right? Until it fails, right? And this right here, you know, a lot of people understand this, right? They know this is an uptrend, and people can start seeing, you know, their trend lines form. Let's go to our trend line. They can start seeing trend lines form. They can start seeing channels actually form, right? And all the retail analogy, right, for trading. But the thing is, it's all good in theory, right? But the thing is that in the actual markets, in the live markets, they almost never are going to move like that, right? And the actual markets, price is gonna move more like higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, barely higher high, higher low, and then continue, right? And now this is going to be a little more complicated, right, to see, but at the same time, if we look at it, it's just a series of higher highs and higher lows, but now they're not being so pretty, right? So now, you know, you can have your support here, you know, your resistance here that comes back through it, then goes back on top, and over here kind of worked, but then it didn't. Like, I don't know how, you know, you can find a retail explanation for this, right? And then but in this video, we're going to take a look into the idea of institutional order flow. What is institutional order flow? Well, institutional order flow is based on the ideas of Wyckoff. Okay, these ideas are 100 years old. Like, I didn't come up with it. You know, most people that teach him also on YouTube did not come up with it. These ideas are, like I'm saying, like more than 100 years old, and they have worked for more than 100 years old. Okay, for more than 100 years, so they still stand true, and that's why we use them. Okay, and that's the idea of there's going to be one person or institution that controls the market, and these institutions are going to protect the market because they're the ones that want to take the market in a certain direction, right? To what? To make money. Now, in order for them to make money, in any market, there has to be two sides to the coin, to the same coin. In every transaction, okay, there's have to be two parties, one willing to buy an asset and one willing to sell it. Okay, it doesn't matter how much I want to buy a car. If there's nobody willing to sell me a car, then it doesn't matter if I have $1 million and I want to, you know, buy a car, but if there's nobody selling me a car, I cannot buy a car. So the same thing happens in the market. Like we don't just print money out of thin air. Every time you get into a trade and you're making money, somebody else is losing money, and that money is coming out of their account and going into your account. And every time you're losing money, somebody else is taking that money. Okay, so there's always two sides to the same coin. There's always two parties to the same transaction. Okay, so knowing that institutions, even though they might have trillions of dollars sitting, you know, in cash ready to buy, you know, an asset, you know, a currency or pair or stocks or crypto coin, whatever it is, right? They cannot do it if there's no other party willing to take the other side of that trade. Okay, so that's when the idea of liquidity comes from. Okay, the idea of liquidity is that, for example, in this, let's say this is a daily run. Okay, this is a daily structure. So inside this daily structure is going to be higher highs, higher lows, higher highs, higher lows, higher highs, lower lows, lower high, lower low, lower high, lower low, lower high, lower low, equal low, then turns bullish, it remains bullish, it goes bullish, it remains bullish, goes bullish, it creates equal lows, fails to go higher, turns bearish, then turns again, still remains bearish, turns bullish, remains bullish, continue bullish, right? And then continue bullish, creates equal lows, and then the run keeps going, right? We're just gonna stop that because we don't have space. Okay, and let's say we're gonna make this, let's say this is a 4 hour. So the orange, let's say it's a daily, and let's say the green is a 4 hour structure. So most of the times what's going to happen is we're going to see this structure, right? And you're trading this structure, and then it fails, it breaks structure, right? And now because this fell, you're just saying, you know what, we broke structure, we are going south, we're going all the way down here, when this is just maybe a pullback of the daily to keep going higher, right? And what it's going to happen here. So the idea of institutional order flow, right, is that when institutions get involved here, they have to create liquidity below every swing high or swing low. There's going to be, you know, buy stop or sell stops, and those are orders. Those are orders that institutions want to get to, right, in order for them to create that other side, right? So what they're going to do is they're going to print this fake structure in the market, and this fake break of structures, right, to trick people into selling this market to create more liquidity so they can just run those liquidities, right? So for example, if we go here, right, as we break this high, right, a lot of people are starting to now buy over here, right? Let's say you buy over here and we break structure. Now people that bought over here, they're trailing their stops over here, And whenever you buy, your stop loss is going to be a sell order, right? So you're selling. And if this is a bullish market, what do you think institution wants, right? They just created this bullish structure for people to have stop losses over here, and now there's going to be millions of dollars even inside these inner structures too, right? That when they take the orders up here, what they're going to do is they're going to take the market down to take these stop losses that now are millions of orders that they are now buying into. They're buying into these orders to then finally liquidate all the lows, down here, and now continue taking the market in the desired direction that they originally wanted to, right? Which is, to the upside. But then even here, now you have more liquidity being printed, because now over here you're taking stop losses on this side, but also because you're in a bearish market, people are gonna be placing sell orders above here, right? They're placing sell orders above here, and now all these people that are selling over here, right? They have this. They have buy orders above here because they're selling. So the opposite is buy orders. So when they take the market in the opposite direction, all those buy orders, helps them take the market basically to the upside and start closing the positions that they sold over here to buy. They start to buy more on the downside, right? That are the orders that they want to take to the opposite side. So it's the idea of selling to buy. All right, it's that liquidation of, sometimes you place a trade and a candle would just go down just to take your stop loss to then continue in the original way that you wanted to trade, right? So now you know why that happens, right? It's because you have institutions basically trading through, because they know that you have the stop loss there, because your stop loss means they're gonna buy that order, right? And then take the market in the original way, right? The original bullish market that they wanted to take it originally. So that's the idea of market institutions, that now institutions will have created a protected low over here, that they don't want to go lower than here, because this is where, if they go lower than here, now basically they're going on drawdown, and they don't want that. They want to push the market higher, and as they come back to close basically orders, because this big pull down, it's basically one big demand block, right? This was a big bunch of orders over here. They sold over here, they sold over here, they sold over here, they sold on all these points to push the market down so they can take all these stop losses, right? And all the people that were, trailing their trades to close them out, right? So they can buy into those orders to accumulate more of those positions. And as they start running the price to the upside, sometimes they cannot close all those trades. They can close some of them, some of these sells, but sometimes there's not enough liquidity because price just moves so fast, because there's so much demand now, because they have bought, and now all the stop losses of people here, now those orders are getting filled too, right? They're getting taken out of the market. So the price, the price of the asset just skyrockets really fast, and sometimes it doesn't give them time to actually close, or they don't have enough liquidity to close all the orders that they sold to buy, and this becomes on a higher time frame, this move down could be just one big candle, right? And what happens is, as price goes up here, they start taking profits and they push the market back down to finish closing all the orders from this demand block, right? To now do the same thing, manipulate more lows, accumulate more orders, and do the same thing all over again, right? And they push price up, and now they accumulated so many positions and they close all the positions over here that they don't need to push the market all the way down. They just redistribute and accumulate more positions and take the market even higher. And then over here repeats again, right? Where they couldn't, market move so fast that they couldn't close all the orders over here, and they have to push the market back down to close these orders. And now we created the idea of they're creating liquidity on both sides of the market to get into positions and to close the positions that they're opening against the trend, right? Just to come and take out your stop losses, right? To accumulate more positions to take them in the opposite, in the opposite direction, right? And then you're just sitting there like getting taken out, to the top and to the bottom, and you don't know what to do. Okay, so the idea is that we're creating this swing highs and swing lows on a higher time frame, that even though all this structure, the inner structure, is going crazy, this higher structure overall is holding, and they don't want to break, they don't want to go below those swing points, because those are protected swing points. Because if they actually go below this swing points, they will be in negative positions that they shouldn't be in. Okay, because the majority of orders are basically buy orders. So if they start selling too hard and go below the swing point, now all these orders, now they start to go negative, right? And they don't want that. They want to push the market even higher to make more profits, and then take some of the profits up here, accumulate more orders, manipulate some of the lows over here, and take orders on both sides, and then take the market higher, then push the market back down, close all the orders that they have to sell to buy over here, and then continue. So institutional order flow is a series of swing lows, right? Protected swing lows by institutions that they don't want price to go below those lows, because then they'll be in negative positions, right? And when we have breaker structures and we have those run ups, we are going to have, this breaker structures, because this same thing that happened here is happening inside the green structure. If we zoom in, right? If we zoom in a lot, the same thing that's happening on the big run is happening over here. A breaker structure that comes back into the last demand block, right? To mitigate those orders and continue the run. And as institutional traders, basically this is how we're getting into the market, right? We wait for the inner breaker structure. Once it breaks the structure, we wait on the last demand blocks for price to come back, mitigate those orders. Then we get in, and now we are on the same direction with the institution. Okay, the institutions are showing us their footprints, and we just have to basically step on the same footprints and just ride along with them. Okay, so basically what we're doing is we're just, we as retail traders, it doesn't matter if we trade institutional trading, if we do retail regular, support and resistance trading, we all retails. Okay, like we, with our $10,000 account, $25,000 account, $500 accounts, we don't move the markets. Okay, big institutions and governments are the ones that move the market. They want to take the market whatever they want, but but because of the nature of the market, that they can't just buy. They have to create that liquidity, right? They have to create those orders. They have to manipulate people into thinking that the market is going one way, so they can actually, take their stops and create that liquidity so they can buy into their stops to accumulate orders and take them in the opposite direction. Now, as institutional traders, we can, instead of trading this resistance or this resistance over here, right, we can actually just sit back, wait for this breaker structure, and then wait for price to come back down and get an entry over here and continue and ride this long trend together with the institutions. And that's the way we trade as a demand and supply, traders following institutional order block. Okay, so all this, we can go to the charts and see it in live action, right? So we have a series of, this is the daily, right? We have a series of go here, we have a run, we have a lower low, higher low, lower low, higher low, lower low, higher low, lower high, but we don't know that this is a lower high until this lower high, higher low gets taken out, right? We don't know this until this gets taken out, because price can easily just come down here, right? Even this low right here wasn't lower than this one. Price could have come here and then continue higher, right? And this would have been the run, basically a higher high, and this will be the higher low, right? But once price broke below here, right, now we know that we broke structure. Okay, now we know that this is the lower high and this is the lower low, and now we have a lower high and a lower low, lower high, 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 and now we're expecting for a lower low, right? And that's the delivery of price. And as you see, we go up, break down, never come below this low, go up, come back down. And even though you see this inner structure over here that we broke structure, and the inner structure over here, it never went below this low, right? Actually, I think it went below just a little, but you can see that that is just market manipulation, right? It's the last sell to buy, right? A last sell to buy, that in the future you can see that this is the last move down, and then trades above, and then comes back and trades into it, right, to go back up and then break structure to the downside. And now we are in this big bearish market, right? And now if we go to a higher time frame, we are in the daily right now. If we go to the weekly, it makes sense why this is happening, right? Because on the higher time frame, on the weekly, we can see perfectly that we are on this long-term, all right, lower low, lower high, lower low, lower high. All right, this is inside this range, so this one doesn't count, and we're expecting to print what right now? A lower low on the weekly, right? And that's what we're doing right now. This daily bearish market is coming down to print this bearish weekly leg, right? And then from once it comes down here, we're probably expecting for price to come back up and then keep going down, right? So that's the idea of a structure, regular structure. Now on the next video, we're going to be talking about fractals, fractality of the market. We kind of like touched the surface right now by showing you that this weekly leg, we have this other inner daily structure, right? And if we go down to the daily, you know, right now we are on this big weekly or even monthly leg, right? And then within that, we have this daily structure that is delivering right now. You know, we have this pullback, and right now is delivering, you know, in a bearish manner. Now, as a institutional trader, we know that the market is bearish, and we're just going to be looking for bearish plays until the market, instead of be, you know, every time just sit here and be looking to the left side and be like over here, oh, the market is going down, there's, you know, resistance over here. You know, when this breaker structure happened, instead of looking to the left to find resistance here, you know, this, I mean, support here, this resistance that turns support now, and waiting for price to come back down, trying to sell here, trying to buy here, right? Because I'm thinking, oh, price needs to, you know, it overextended too much now, it has to go, you know, it can't go this lower. You know, this was a big run, the market is really bullish, right? And as this starts to come back down, instead of me trying to buy here, right? Buy here, buy here, buy here, buy here at this resistance, all this resistance, right? All these people that see resistance here, they're buying here and then felling right away. You know, then you have another resistance here that play perfectly, right? Supposedly, but then automatically fails, gets run through, right?